everyone. I hope everyone had a wonderful new year. So John and I are located in the Chicagoland area, so we're preparing for a heat wave this week. We've had some cold weather, some snow, just a little bit of everything. But if you want to use the question section of your GoToWebinar control panel, you can let us know where you're tuning in from. We always love to hear, especially during our annual Model Portfolio Review Week. Thank you so much for joining us. We'll let everyone kind of get settled for just another couple seconds. And if you want to share, also, I wanted to ask our audience, I always do, especially for our shadow stock, is if we have any shadow stock portfolio holders in our audience. And if so, we always love to hear also how many stocks in the portfolio that you're currently holding. So you can feel free to share that via the chat at any time. All right, looks like everyone's about settled, so we'll get started. We have a great presentation ahead and a lot to cover, so I'll try to make my intro very quick. But hello and welcome to this afternoon's webinar, AAII's Model Shadow Stock Portfolio 2025 Review, led by John Bajkowski. Thank you so much for joining us, and we are happy to have you all here. So my name is Jenna Brashear, and I will be your host for today. I want to welcome you to the kickoff event of our Model Portfolio Review Week 2025, or 2026. And it's our favorite week of the year at AAII, and we're really thrilled to have you join us for all the excitement. So each day this week, we will be going through our model portfolios. We'll take a look back at each portfolio's 2025 performance. We'll celebrate some of the stock wins, look at any of the challenges, as well as share our goals and some insights as we set our sights on an exciting 2026. But before we begin, there are a few things to go over. First off, I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And please keep an eye on your chat section throughout the webinar for helpful resources, key information, and of course, I'll put in our special offer. And then if you have any questions for our speaker during the presentation, please submit them using the questions section of your GoToWebinar control panel. And then once our presentation concludes, I'll select a few for John to answer. If your question isn't selected during the broadcast, you can feel free to email us at members@aaii.com. Presentation slides are available under the handout section of your GoToWebinar control panel, which is located on the right-hand side of your screen. It will also be emailed to all the attendees today. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings. And you can go to the website gotowebinar.com for support. And then just a friendly reminder that this presentation is recorded and a replay of the webinar will be available on our YouTube channel, along with links to this presentation's handouts and any resources that we find helpful. The PDF and the recording will also be accessible at aaii.com/webinars later this week. And then in this presentation, John will cover a few things, such as lessons from the Shadow Stocks portfolio's 2025 performance, some insights into the factors driving small cap stocks, and then some strategies to empower your small cap investment decisions in 2026. And then we have a special offer, like I mentioned earlier, for today's attendees. So please stay tuned for the details. Attendees will be able to get a $50 discount on any new one-year subscription to any AAII premium product, including AAII Platinum, by visiting aai.com/webinar-week, and then you can enter the promo code WebinarWeek50 at checkout. And I know that's a lot of information to digest and kind of get a hold of, so please don't worry. I will add it to the chat momentarily so you can easily access. And with that, I'd like to hand over the presentation to John.
Well, thank you so much, Jenna, and welcome to our special presentation today on the Model Shadow Stock Portfolio. And I know Jenna's going to be back there listening to the questions that you guys post in the questions area, and I'll do my best to answer those as we go along, or as probably more so towards the end of the webinar itself. And again, at the end of the week, we'll be asking Jenna what her biggest lessons learned as far as the stock market have been this week. So we encourage anybody who's listening here to sign up for our webinars. Even if you can't attend a given day, a notice for replay will be sent to you. You can catch in and check up and see what our different analysts have to say about the market as we've experienced in the past and what we look forward to in the future. So with that, let's get started. So yeah, my name is John Bajkowski. I'm president of the American Association of Individual Investors. And if I can get my slide deck to advance here. I'm having trouble with that. Of course. One quick moment here. Sorry, apologize for that. I'll have to click it that way. Very good. Yeah, so our agenda for today is to give a little bit of background research on how the shadow stock model portfolio came to be, the research behind it, and how it kind of exemplifies how we as an organization have tried to take academic research and the various types of tools and knowledge that exists in the open market and make it turn into actionable events that our members can make use of as far as managing their portfolios, strengthening their total return, gaining any kind of confidence and understanding of the marketplace. So it's really, I think, been proven to be a very interesting example of how one can take very theoretical, educational concepts and convert them into tools that help you manage your portfolio, tools that help you select stocks, decision points, and how one manages and buys and sells securities. So I think in that context, it's proven to be a very interesting exercise for both the organization and both for our members as well. And I'm going to present the current model portfolio construction rules, how we manage the portfolio, how we make decisions as far as buys and sells, and take a look at how the market portfolio is done, how the market as a whole is done, and what kind of insights they gives us as far as how the future might hold for us as far as investors are concerned. So the original shadow stock portfolio goes back to '93, and as an organization, we've always felt that small caps provide an interesting opportunity for individual investors to potentially profit from. They tend to be less followed by Wall Street. There's probably a better chance of mispricing within the small cap arena. They're in the shadows of Wall Street. That's where the term shadow stocks comes from. And the whole genesis of the idea was that, well, there's a lot of research that shows that small caps have done well and value has done well long term. How can we create some very simple rules to help manage that? What can we learn from that process? And it hasn't been all, perfect as far as that's concerned. The primary genesis or the primary interpretation that we really used to form the model shadow stock portfolio back in the early 1980s was actually, I guess in this case, 93, sorry, was the famous Fama-French analysis of the market and the various factors that had as far as explanation on how future stocks would perform. So in this well-known study, they took a look at a lot of different factors or predictors or considerations of if you took a look at a cross-section of stocks today that had certain characteristics, how have they performed over time historically? How have low PE stocks performed? How have low price to book stocks performed? How have large caps versus small caps performed? If you take each of those types of factors or predictors and you take the market and break it into chunks or deciles or 10% ranges and invest in that portfolio over time and over a year and rebalance every year, how helpful have those types of indicators been as far as explaining future stock market performance? And in their analysis, they took a number of different indicators and factors into consideration. Now, there were two very interesting predictors of future stock market performance. One was the overall size, and they was consistent with that. Other studies have shown that basically, typically speaking, the smaller the company, the greater its future expected return would be. Again, it's not every year and it's not every stock. It's very important. They're looking at large portfolios of stocks, large groups of stocks, big bands of stocks. And they also found that in general, and independently of that size effect, the cheaper the stock was, in this case, price to book was the one that had the best predictive value over other factors such as price earnings. The cheaper the stock, the better its long-term rate of return. So, and again, they act independently. You combine those two different factors, and using information that's readily available. Market cap is a well-known thing. Market price to book, very easy to measure element. You could use those to help build portfolios of stocks that, historically speaking, should do well in the future. But then it comes into play is, well, how do you go ahead and interpret that information? But what we basically do with the shadow stock is we look for that intersection, that smallest, percentage of stocks that are both small in size and very cheap. And historically, over the long term, those types of securities should form a portfolio that could be outperforming the market versus large cap stocks versus expensive stocks. And again, not every stock will happen that way, not every year will be that way, but it's proven to be an interesting exercise. But it also has chosen that there's some special things you have to consider when it comes to managing that portfolio. Now, before we get too far, I want to first of all explain market cap. Market cap is a commonly used measure of size, and you can look at revenue, you can look at total assets, you can look at number of employees, but market cap is probably the favorite measure that's used to discuss how large a company is, and it takes into account how much the market values a company in a sense of the stock price of that particular entity, as well as the number of outstanding shares. So when, most of the time when we're talking about the market, and even a lot of my presentation slides here make reference to the S&P 500, we're talking about companies that are really pretty large when it comes to overall comparison of how they are. In fact, the largest, companies, largest 10, 20% of the companies that are the largest in the overall market environment make up the S&P 500. So it's a relatively small group of companies. They are perhaps only 15, 16% of all firms that are public, but they make up, 90%, 86% of the market capitalization of all companies that are publicly traded. So most often when you're hearing about reports on TV or the radio or newspaper, talk about the market, they're talking about really the S&P 500, which is the largest companies. And small caps, of course, have become favored by many individuals and institutions. But when it comes to small caps, there's almost two classes of small caps. There are small caps that are investable by institutions, and then there are the micro caps, which is really where most of the studies when it came to small cap outperformance focused in on micro cap companies. These are even companies that are smaller than those in S&P 600 small cap index. So if you take the decile range, when it comes to really the smallest companies that most academics consider to be small cap, you're talking about 9th, 10th decile. These are the smallest within the NYSE and also across all marketplaces. So the shadow stock portfolio, in fact, invests in the smallest 10% of companies that are out there. So you're talking about really in terms of market cap, most companies that are publicly traded are in that range, which is sort of interesting. But when it comes to market capitalization, it's a very small part of the marketplace. So the S&P mid cap index captures this stuff in the yellow range here. The small cap indices typically are in this blue range, anywhere from 1 billion, 3-4 billion as far as market capitalization size. And when we're talking about shadow stocks, really the micro caps of the world out there, we're talking about really small companies. When it comes to the shadow stock, largest companies to consider initially for inclusion is 400 million currently. So it's important when you hear the term small cap in a small cap fund, most small cap funds are really even larger than the shadow stock. So you have to almost get into more specialty indices that track these micro cap stocks if you want to invest in these using mutual funds or instruments like that. So we're taking that lowest group of stocks that are small and when it comes to valuation, really cheap. And when it determine that range, we look at, and this is what academics typically do, we look at all the stocks that are traded on the NYSE, the New York Stock Exchange. We rank them from largest to smallest. We exclude things like REITs, which can trade on those exchanges as well. And most academics also exclude ADRs, foreign companies, to define that range, which we do as well. And so we take that, and we happen to use Stock Investor Pro, and on a quarterly basis, we go ahead and rank all the stocks on the New York Stock Exchange from largest to smallest. We look at those that are in that smallest 10% range. We then take that size that we determine, in this case, about 400 million when we did the analysis back in December. We then take that capitalization size and apply it to all publicly traded stocks, whether they trade on the NYSE, the American Stock Exchange, or the NASDAQ exchange. We take that across all different portfolios as far as that's concerned. That is interesting because that, in terms of its original, when we got started back in '93, our cutoff for that 10th decile was 55 million. It was as high as 500 million back in 2021 through 2022, and it's been at 400 million over the last 2 years, basically, has been our cutoff as far as that size. So again, these are domestically traded stocks, lowest 10%. That's our starting point for inclusion into the portfolio when it comes to the shadow stocks. And then, so that's the size component. When it comes to book value, it's the same thing. We look at stocks that we take the NYSE range, we break them into bands, largest, the most expensive to the cheapest, and we look at those stocks that are in that lowest 10% range. And right now, that happens to be in that 0.9% or so as far as the current, oops, strike that. Yeah, about 9.9% is the current price to book maximum. It's been over time. When we first started, it was back 0.61. Lowest was 0.60, and that was after the tech bubble of 2000. It's been as high as 1.1 from 2021 to 2022. And when we did the analysis, just by way of comparison, this just shows you the median price to book of the companies that are in the S&P 500. Right now, the most expensive stock we'll take into consideration for the shadow stock portfolio has to be a 0.9 or lower. The median for all stocks in the S&P 500 right now is 3.56, and that's down a little bit from a year ago, but it is on a relatively high range. And I have a chart later on that helps illustrate how those cutoffs have changed over time. But it's important then to understand is that what we found, and this is where the whole notion of taking a theoretical portfolio and making it into a practical portfolio is that you have to create special additional filters or conditions or qualifying considerations for picking a portfolio and running a screen or any kind of analysis you do. You want to make sure that these stocks are there, they have minimum liquidity. We want to make sure these are not penny stocks. We want to make sure that people can buy and transact in these securities in a reasonable basis. But we found that it's very costly to quickly transact in these very less liquid stocks and say the ones that are in the 500. So we ignore any kind of stocks that are on the OTC. We have to have a share price of at least $4 when they first join. We look for things like this to make sure that these are investable securities. They're investable for the individual investor. They're probably a little bit too small for most large institutions, but they are really an important minimum level of transactional ability for the individual investor. And what else is important is when you look at profitability, and especially when it comes to small caps, and that's if you do follow indices, if you want to do a benchmark. One of the requirements for inclusion in any S&P index, whether it's the 500, the mid cap 400, or the small cap 600, is profitability. The Russell 2000, which is also a widely used index of small cap companies, doesn't have any kind of profitability requirement. And you'll see a big divergence in those indices over time. And one of the things we found very important is that we had to have some minimum level of financial consideration, some minimum positive earnings quality or ability. And what studies have shown is that when you want to invest in small caps, it's very important to really avoid the junk. And you'll have a much better rate of return if you avoid those that are the weakest companies that are in there. Companies make it into that small cap arena for a couple reasons. They could be large cap companies that have fallen on hard times, or they could be up and coming companies that are growing up. And what you want to really avoid are companies that are perpetually and on a regular basis having sort of financial distress. And small cap companies, very often, they can go bankrupt more easily than large cap companies can. So it's important to have some level of financial quality check. So if you're doing any kind of screen for small caps, I highly recommend add some level of financial quality or strength to it. Ours is very simple. It's simply looking at positive earnings over the last year, last quarter. If they happen to have any analysts that are tracking them, positive forward earnings as well, expectations for the current quarter. So we're looking for simply some level of positive earnings. We want to have, it's a minimum, not much of a quality screen, but it's also an important consideration for when it comes to selling a stock as well. We also avoid any stocks that was sold from the portfolio over the last 2 years. And again, it's just, one of the, I guess, issues that comes up in this bullet point here, avoiding stocks that are financial here, is that we use price to book as the primary metric when it comes to determining value. And one of the, price to book is good because it impacts a lot of companies. They're not necessarily be profitable to determine it, but it doesn't really work well for companies that have assets such as part of their, as financials do, as part of their balance sheet. So from that context, academics exclude financials for their studies of things like price to book analysis, and we do as well in our portfolios. We do ignore that whole segment of the marketplace. So it's a challenge, but that is one factor that comes into play with managing the shadow stock portfolio, is that you're not going to have any financials in it. If you want financials, you want banks, you're going to have to use you have to either use a different metric to measure their valuation. And that's probably one way to go ahead and do that. So, when it comes to constructing a portfolio, all these academic studies were based on putting together large portfolios, large segments of portfolios, a big bucket of portfolios, big bucket of stock that have similar characteristics that are more predictive in the future. So when it comes to managing a personal portfolio, the fewer stocks you have, the more careful you have to be in picking them to make sure they carry the characteristics of what it is you're trying to achieve. It's a diversification play, but it's also a characteristic play. So when it comes to building a portfolio from the shadow stock ideas list, or our current portfolio, if you want to really capture this effect, I recommend you have at least 10 securities that'll give you some probability, spread across different industries, some chance of kind of capturing the same kind of style the shadow stock portfolio happens to have. Again, as you have more money you want to invest in it, you also have to kind of spread that load across a large group of stocks, although you'll start to impact the price movement when it comes to buying or selling your positions. But really, nowadays, with commissions being in effect free or zero, or priced into what other services you pay for, there's really no reason why you can't build a larger portfolio. Or if you want to follow all the shadow stock portfolios, perhaps exclude those that are under probation, or have other disqualifying notes. But really, if you want to capture an effect of such as this, and if you don't want to do a lot of in-depth research on each individual holding, you want to hold as many of them as possible to capture that effect. Gives you some diversification and gives you a sense of understanding of how you're going to capture that effect over time. This happens to be the current list of shadow stock portfolios. I think there's 28 stocks in our portfolio as it comes now. This happens to be ranked by price to book. And this highlights some of the issues that perhaps are considerations when it comes to building a portfolio. Any stock here that's marked as currently qualifying meets all of the initial rules for when it comes to buying a stock. And then there are also then rules we keep note of. If you go on our website, we'll keep track of this on a daily basis. If a stock also happens to be under probation of some sort, the biggest types of probations, stocks are sold because their earnings turn negative for a consistent period of time. They get too expensive in terms of price to book, such as in this case, Gilead Satellite Networks is becoming expensive on its price to book measure, or they get too large. And I guess the fourth factor is if they've been in our portfolio for over 3 years, and they're not outperforming the market, not providing a positive rate of return, they'll also be sold. So those are the primary reasons that our companies are sold when it comes to their shadow stock portfolio. If you go to our website, if you go click on the current portfolio, and I'll show you where that resource is later on, you get a sense for all of our current portfolio, any kind of special rules. And so if you're building a portfolio, you might consider initially starting on the currently qualifies, might rank it for price to book, you might want to ignore companies that are under some sort of probationary factor. In this case, we have Lakeland Industries, which is under probation, earnings probation, as far as earnings are concerned. So that's one way to go ahead and build this portfolio, and it gives you a sense for even the types of industries we have in there. A lot of industrial companies, a lot of it's consumer discretionary as well, as far as portfolio composition. So getting more into the management rules, the understanding was that when it came to these small cap companies, you could not really quickly trade them. You would be in effect paying a big cost on that spread, even beyond the brokerage costs, because we often, if you're moving a lot of money, or if you have a lot of individual investors such as AI members buying and selling the same stock at the same time, they might actually move the stock price a little bit. So, and Jim Clunan, the founder of the AAII, and also the founder of the shadow stock portfolio, really was a believer that really he wanted the metrics to drive the portfolio decisions, and he felt that it was costly to be doing too much transactions. So he thought the best way to really understand when it was time to buy and sell a stock was review it after the company reported its quarterly earnings. So we review the portfolio on a quarterly basis to kind of coincide when companies provide new, fresh financial information as a way to make decisions, and that then impacts, the market cap. It impacts the price to book. That impacts profitability. So, basically, after most companies have reported their financials, we go ahead and do another analysis of the market, analysis of the portfolio, and we go ahead and decide if any stocks now qualify to sell, or if they happen to be any kind of new candidates to buy. So when it comes to selling, we don't, we have rules. We have, we want to buy stocks when they're cheap and when they're super small. We want to give them a little bit of room to run up. We want some of these stocks to become winners. We want them to, in effect, become larger, become, perhaps more expensive before we sell it. So we buy them. Our sell rules are tied towards our initial buy criteria. So, but we in effect sell them or remove them from the portfolio when they become 3 times the original maximum for being included in the portfolio. So in this case, when the price to book ratio becomes 2.7, 3 times the initial 0.9, and if there's happen to be stocks passing, and on the market cap level, right now at 400 million is our initial large size for including. So we sell them when they become 1.2 billion as far as size. If earnings are negative, and we look at typically normalized earnings, not necessarily GAAP earnings. We look at those are the types of earnings that you do adjust for one-time events, and most services, we happen to use S&P as our data source. We look at that. We look at the earnings estimates. Those are typically normalized, and we feel that's a better understanding of what's happening underneath the company's overall underlying business. And if it's been held for more than 4 years, unless the stock price is up, we also sell it. So I think I said 3 years before, so that was a mistake on my end. Used to be a 3-year rule. We actually expanded it to 4 years just before Jim retired. So again, those are and it's done quarterly, and the portfolio turnover is relatively low. We had a lot of stocks transact in the June review, the second quarter review, and then no transactions since then based upon portfolio holdings. We had 1 stock come on and off probation and 1 stock on probation currently. So relatively low as far as turnover. And again, if we happen to remove a stock from the model shadow stock portfolio because it's become too large, but it's still cheap, there's no reason why you can't hold it in a mid-cap portfolio if you so desire. But really, it's important to have these rules in advance because, if you're like me, I mean, it's easier to find plenty of fresh ideas than to decide which stocks to prune. So really having these ideas and having these rules that are followed, disciplined over time, really, I think is an important way of making sure your performance is kept in check, your emotions are kept in check. I mean, it's too difficult, you fall in love with your stocks, but if you have no, specific factors as far as why to sell it, humans on average, they tend to sell their winners too quickly and hold on to the losers too long. So it's just as important to have rules to sell on the positive side as well as on the negative side, because you're going to probably want to hold on to those losers too long, which is why you even have a 4-year rule. So I'm making sure these stocks are going nowhere. Let's go ahead and move on and find some more interesting candidates when it comes to that investing. And one more point before I move on is that it's important that when it comes to, since these stocks prices are all varied all over the place, that we typically look at the position size. We look at average size. We want to buy equal dollar amounts of your investments. That gives you better diversification. And you could also rebalance into those stocks as long as they still have positive financial qualities that are perhaps not become a smaller portion of the portfolio. As far as the performance of the portfolio over time, it's been a bit of a challenging 10-year streak for small caps. I know that for the last year, the model shadow stock portfolio did actually outperform the S&P 500, which is a little bit unusual because small caps in general underperformed, but the shadow stock portfolio had a return of 18.8% last year versus a total return gain of 17.7% for the S&P 500 index as measured by the Vanguard 500 fund. The NASDAQ small cap fund was up 8.7%, and the dimensional US microcap fund, which is probably the closest thing you're going to find as far as a true small cap academic fund, that was up 7.6% for the year. So it was an interesting year. This chart is a logarithmic chart, and actually let me switch to the next chart, probably even a better representation of this. Is tracking the relative performance of the shadow stock fund versus that of the S&P 500. When you see this index line going up, that's a period in time where the shadow stock portfolio is outperforming. You see it going down, it's a period of time when the shadow stock portfolio is underperforming. So we know that, I'm sure if you've been reading it all and following the financial markets, last 10 years in general really have been sort of a challenging market. This is going back 10 years, a challenging market for value and a challenging market for small caps. But about midpoint this year, all of a sudden, investors seem to be more interested in their understanding of how value relays impacts large caps. They had to consider more the impact of value, and typically small cap stocks do better as a whole when interest rates are dropping. Their small cap stocks are typically more domestically oriented when there's a greater understanding or a greater belief that domestic companies versus international companies foreign companies will be doing well. So we really saw this pickup after the initial decline we had this year from the tariff announcements. All of a sudden, the expectation of additional Fed fund easing, the expectation of a continued strong domestic marketplace really helped rotate money into small cap and value funds as a whole. Now, we know that when it comes to investing, any kind of approach, in this case, small micro cap value, large cap growth, sector rotation, whatever, in any given period, the random walk down Wall Street. I mean, in the short-term basis, the qualities of what make one stock better than the other may not necessarily win out. You're going to have to hold on to an approach. And every approach will have a period where it goes in favor and out of favor. And on a 1 month basis, it's almost it's a crapshoot. Will the model shadow stock portfolio outperform the S&P 500? 51% of the months it has. That's pretty much that's almost noise. 1 year, same thing. I mean, any given year, the model shadow stock portfolio might outperform or underperform. That's tough to say. You almost have to go out really to 3 years or 5 years, really. I think probably 5 years, probably a better chance of whether or not, a strategy starts to take hold. 5 years, you start to see how, okay, the qualities that make this particular approach attractive are taking hold. So if you're going to invest in an approach, I mean, you have to have, a great understanding, a great belief of it, because you're going to have to work through some difficult times. And it's especially true of small caps, which tend to typically run in streaks. And this could last several years. But in any given year, whether or not the shadow stocks or any approach outperform the market, that's almost a flip of the coin. 5 years, 10 years is when a given approach will really, help give you understanding of how well it's going to do and whether it has any characteristics to help it outperform the market. And those are things you look for today. And of course, the challenge is things do change. And you want to make sure that whatever approach you have is consistent across long periods of time, consistent across different countries, and is repeatable. It makes sense. It has to have some kind of sense as well. You don't want to go ahead and test a strategy and backfit it to a bunch of data and have it work perfectly historically, but have no correlation to the future. So really, when it comes to why potentially small cap value works, is that these are companies that are out of favor in the sense of they're smaller, they're less liquid, they're riskier. That's part of the reason why they outperform long term as well. You're holding that, you're taking that short term volatility away, and those are some of the factors that help these small cap funds give them their long term return characteristics. But this is a chart I couldn't find an updated one for this year. But again, it helps to illustrate in a graphic form the serial correlation that occurs with small cap companies. They run in streaks, and often we think back to the internet bubble bursting back in 2000. They had a whole decade where they underperformed. Or in this case, the large cap stocks outperform small cap stocks. It's critical that you have a understanding of that, and that you don't necessarily go ahead and jump at the wrong time. Too often people jump off a particular approach that is still sound right when it's time for it to turn around to occur. The other consideration, I guess, is that beyond outperforming the market, how much, how do bear markets impact your investment approach, your investment style? In this case, the shadow stocks versus the S&P 500. Now, we do all of our analysis on a monthly basis, so there is a little bit of that's the smallest discrete unit of measure. Historically, when it comes to the shadow stock portfolio versus the 500, is again, it's more volatile. You're going to have more down periods than large cap companies. Normally, they've been shorter in length. When you have a downturn, they normally bounce back more quickly. We're just coming out of this latest downtrend. It took 4.6 years to really come out of this latest downturn, this latest bear market, it's been it's interesting in that context. So you're going to find typically more volatility with small cap investing. You want to make sure I understand that. Typically speaking, they bounce back more quickly. But again, while history rhymes, it doesn't always repeat itself. In this case, the downturns have been typically more frequent for small cap versus large caps, and the drawdowns, the level of downturn has been often more severe as well. So it is a higher risk approach, and again, it makes sense to balance it with some other analogies or other types of investment approaches as well. Be it large cap, it could be a component of large cap, international. So these types of concerns. In the long term, the approach is done well. But when it comes to the last other slide, we talked about outperforming the S&P 500. When it comes to holding periods where you just had a loss in your initial investment, about 40% of the time, but with a 1 month holding period, there you've had a loss. Again, 1 month holding period. A 1 year holding period, about 29% of the time, the shadow stock portfolio was negative versus 18% for the S&P 500. 5 years, only 5% of the holdings were negative, which is interesting because it was actually less than that of the S&P 500. And really, you have to allow 10 years, at least from our experience. And again, there's no past performance, there's no guarantee of future results. But you have to go back 10 years to really get a guarantee. This is in nominal dollars. It's not inflation adjusted either, where really you have a period of no losses in there. Even with the S&P 500, we had 9% of the time, these are rolling 10-year periods, we actually had a loss. A market experts say that really, 15 years is almost the minimum cycle that you have to be kind of to really truly judge a sort of market cycle or expectation when it comes to the marketplace. And how did the market do last year? Well, S&P 500 again ruled. Large cap growth was the dominant approach last year as well. I know it had a little bit of breakdown over the course of the year, so it's perhaps outperformance wasn't as great. But 3 years running now, where the S&P 500 growth has been the most highest performing sector amongst the S&P groupings. But it's interesting is that when it came to mid-cap value and small cap value, those actually did better than their large cap counterparts. So it's interesting that the value was proving to be a little bit more attractive on the small cap and mid cap size. We know that, I mean, if you are a student of the market at all, if you do any kind of reading at the association or the marketplace, we know the market itself is very concentrated. S&P 500 is very concentrated. If you look at a market cap weighted index, at this point in time, when it comes to the top 10 companies, when it comes to market cap, you're talking about, in this case, the blue line, we're talking about making up 40% of the impact of the performance on that of the marketplace, and earnings-wise, 32%. So it's a very concentrated factor. Top 10 companies are making up, a very large impact on that of the index. This chart even helps explain that impact of those, in this case, the Mag 7, even a smaller group of companies. The green line here represents the S&P 500, I'm sorry, the performance of the Mag 7. This dark line here is that of the S&P 500, and this blue line here would be what the S&P 500 would have done without those Mag 7 stocks. So we know that they are having a outsized impact on the performance of the S&P 500 and the growth component. That's why we're seeing, as long as interest in, information technology, artificial intelligence is driving up interest in those stocks. It's also driving up valuations for those stocks, but it's also providing growth. Those companies are having growth as far as that's concerned. But that has been a tremendous impact on the portfolio of the S&P 500. When it comes to sector performance, 3 years running now, along that same theme, 3 years running now, we've actually had the communication services sector be the top performing sector within the S&P 500. The challenge there being, if you're invested in other sectors, it's tough to keep up with that portfolio. So you might be getting, a little bit, upset about yourself or upset about how your portfolio is doing. So if you don't have, NVIDIA in your portfolio, if you don't have communication services in your portfolio, information technology in your portfolio, it's going to be very difficult to outperform the market or keep up with the market. It's for any kind of, some of the trends we did start to see this year finally. We saw healthcare kind of bounce back, especially towards the second half of the year. All of a sudden, people were finding value in healthcare. Of course, last year you had utilities do extremely well. That was part of the electricity demand for AI, artificial intelligence, that helped drive up the utilities prices. When people are very positive about the economy, spending a lot of money on purchases, consumer discretionary stocks do well. This year, both consumer discretionary and consumer staples kind of struggled as far as that was concerned. So if you're investing a lot, if your screens you're running are passing companies that are in the real estate or consumer discretionary or staple stocks, you're going to have a tough time performing well if your approach finds those kinds of companies. When it comes to how those sectors impact different size indices, this chart kind of explains that. This tells you that when it comes to the impact that information technologies, which we saw was one of the top performing sectors the last 3 years running, it hit, 34% of the companies of the S&P 500 are in infotech. Only 12% are within the happen to be in the mid cap index. So the sectors also have a different weight by size as well. So that's interesting as well, as if you simply are looking at smaller cap companies, you're going to find a lot more healthcare companies that are part of that. You're going to find more financials that are going to be passing small cap screens. And valuation wise, when it comes to this is we talked about how important it is to screen on financial strength. When it comes to small caps, most small cap companies are unprofitable. 39% of the small caps are currently unprofitable. So if you want to filter those companies out, and you can have a much better chance of them performing well. So really, that's a thing to know about different marketplaces when it comes to look at that, how the profitability goes up as the company size goes down. So it's very important to understand that. And we talk a lot about valuation. This is the valuation level of the PE of the index itself. And it's funny because it's the PE is a popular measure. When it simply a current assessment of where the market is on a price basis relative to future expectations. And if it's a forward PE ratio, the 22 times PE is well above standard deviation of where it has been historically. Normally speaking, when the PE level is high, you expect lower rates of return. But again, that takes a while for the market to recognize that. And a higher PE can be supported by having higher growth, higher earnings growth. And beginning, if we had the same presentation a year ago, the market PE was not that different, even though the market's up 18% this year. Well, that's because earnings grew as well. So you can support higher PE for a period of time as long as earnings keep growing. And this next chart here actually is interesting. It is a scatter plot, and it shows that for a given level of price earnings ratio, what was the subsequent 1-year return or 5-year return. So for any given, right now with the PE at 22%, you'd expect to perhaps on average, this is not a very not a very tight fitting line, a return of this case positive, because the market in general has a positive rate of return, but it looks like to be what, maybe 10%, 7%, actually going forward. But look at this large diversion. The spread is so wide on a given 1-year basis. If you start to look out 5 years, things such as overall asset allocation levels, valuation levels become more meaningful when you're looking at, okay, this is a better predictor going 5 years. Even the popular CAPE ratio is a 10-year average of earnings. So, no one rings a bell when it at the top or the bucket bottom, but we know that in general, markets are a little bit expensive now, especially in large caps, much cheaper in small caps and mid caps. So we know that, the possibility, the likelihood, you're much better off investing in the market when the PE ratio is 10% or 11%, 11 times forward earnings, as opposed to when it's 20 times forward earnings. So again, if you start looking at things like valuation levels, it's difficult to predict year to year what they're going to do. Longer term, they have a much better predictive value of what they're going to be doing. And this one chart here just shows major inflection points, which I thought we kind of include as a frame of reference. When at different points in time when the market hit tops or bottoms, what was that PE ratio? What was that valuation element? So it's interesting. It gives you some factors of how those things happen to be at different points in time. So right now, as we close off the year, the forward PE was 22 times earnings. The dividend yield was 1.4, relatively low, historically speaking, and 10-year treasuries were 4.2. Down over the last year, but really relative to the most historic norm since the last 20 years, relatively high. Historically, not so bad, but the last 20 years, relatively high as far as the 10-year treasuries are concerned. And again, this is just since we happen to be using price to book as the primary metric for the shadow stock portfolio, included this chart here to show that, again, even though large cap stocks are relatively high, the blue line here is the price to book ratio of the constituents that make up the S&P 500. Small cap stocks are much cheaper on a relative basis. Historically, small caps traded at a discount when it comes to price to book value. At 0.65 right now, they're at 0.5. So there's still there's a wider spread between the more expensive S&P 500 and the relatively smaller S&P small cap index. So better value to be found among smaller cap companies. And this last chart here is kind of a reference as well, just to kind of help you understand the returns historically over different size ranges, as well as where the valuations happen to lie currently. How does the shadow stock portfolio compare? So now we talked about how important sector can have an impact on the performance of a portfolio. So we know that, for example, we exclude financials from screening. There are no financials at all within the shadow stock portfolio. We're most heavily weighted in industrials, followed up by energy and information technology. So how those sectors did recently are going to impact our performance. Those sector concentrations change will vary. Again, we've shown a different chart, how they vary by sector as well, by industry, by size as well. So right now, the largest concentration with 8 stocks in the model stock portfolio are in industrials. Only 7.5% of the 500 is in that particular sector. 23%, so we're closer to the mid cap, and small cap is 17.5. Over the last 52 weeks, the stocks that are in that sector, regardless of size, underperformed the S&P 500 index by 10% on average. They have a trailing PE of 25.6, and their forward PE, so this expectation of growth is still 21, which is so interesting that the PE is relatively high. And a PE can be high because a lot of the weakness as far as earnings, or they could be high because expectations are strong for the company. Interesting considerations there. But the sales growth has been relatively strong for the industrial sector, both recently and 10 years, and profitability is there. I mean, healthcare is one of those things that we saw a lot of companies in the small cap arena are healthcare. The majority of them are unprofitable that are in that sector, and they've underperformed the index, and they have a relatively high PE ratio. So again, it's important to filter out the bad stocks from the good stocks when it comes to your analysis. As far as the overall performance of the components that make up the shadow stock portfolio, we found that last year, the best performing holding with 110% return on investment was Gilead Satellite Networks. I mean, that's doubled in price, more than doubled in price, and it has a 9% impact of the portfolio right now. If you see happen to be a weight here that has if it's been sold, this has all stocks that were held in the portfolio this last year. So typically speaking, if you have if you have a reason here, so we had Land Sea Homes, which was acquired last year by a private equity group. But most of the companies that were sold outside of that were sold because of negative earnings, and more of the weaker performing stocks are those that have negative earnings. If you see a start value of 0, that means the stock was actually purchased over the course of the year. This would be the rate of return that we experienced for that stock while the stock was in our portfolio. So, interesting that we actually, oil and gas actually was a relatively weak performing, yet one of our better performing stocks was in that sector as well. So, because of our concentration, again, our variety of performance is sort of varied we have a healthcare stock that did really well, but again, it's all over the place as far as performance is concerned, which is why having a portfolio is very important, and understanding that having good rules to buy and sell is a really important driver for your portfolio performance. So if you want to follow the shadow stock portfolio, all members have access to these resources. If you go to our website, obviously we track them in the journal as well. If you go to our website, you go to portfolio and click under model shadow stock portfolio, it will take you to the home page of the model shadow stock portfolio. We'll have our latest alerts, and we see we haven't had any alerts since those back in June of this year. But we do have a monthly commentary that goes out that tracks the performance, keeps track of those stocks that are passing, and we also track our performance on a monthly basis as well on the portfolio here. When you look at if you click on the current holdings of the portfolio, go to portfolio and click on shadow stock portfolio, you get the list of all 28 stocks that currently make up the portfolio. So if it comes to important information, the notes column helps give you information as far as, okay, is the stock on probation? Does it currently qualify? This gives you, if you want to go ahead and build this portfolio, you might sort it based upon price earnings or price to book or market cap, any kind of special notes to help understand whether or not the stock is on the early stage of being attractive within the shadow stock rules, or if it's perhaps reaching a point in time, we might be selling it in the near-term future. And all of our rules are completely transparent. I know that our members often will act ahead of us as far as that's concerned. Again, it's our goal here is not to create a black box, but rather a very transparent set of rules that are easily repeatable across different market segments by all of our members as far as that's concerned. And I'm just repeating the current holdings here. And we see that we have one stock currently on probation. It happens to be Lakeland Industries. And 1, 2, 3, 4, 5, 6. Looks like 6 stocks are currently qualifying as far as our initial rules for qualification are concerned. And again, beyond the current holdings that are in the portfolio, the filters that are used for initially qualifying, we in effect every day publish a list of stocks that are currently qualifying. A couple things to note, and if they happen to be held in a model portfolio, one thing we don't filter out are things such as limited partnerships. So these we would never add those to the portfolio because their ownership is way different and than a common stock would be. So when it comes to adding stocks to the model portfolio, when we do our review, look for candidates, we do exclude things like limited partnerships, REITs. We exclude companies that are based in China or Russia, and we want to make sure there's enough liquidity to actually adequately buy and sell these types of things. So some of those are factors to consider, and all those rules are spelled out online in our stock and our guide for shadow stock portfolio. And then you could do further research. This happens to be, I just clicked on one of the stock that passed the list, and you can get to our basic stock evaluator page. And I know we have a special offer for the A+ investor if you want to get involved in these investor grades. Typically speaking, all the stocks that are going to be passing the shadow stock screen are going to have probably an A or B value grade as far as that's concerned. Everything else would be up for grade. So actually, if you want to go ahead and take qualifiers such as momentum or quality, you could then apply additional factors, perhaps even track down or narrow down what is concerned as an attractive stock in the model shadow stock portfolio arena. With that in mind, I mean, a couple of the key points to consider is that microcap stocks tend to have consecutive periods of underperformance and underperformance, underperformance. They have streaks. They have winning streaks, they have losing streaks. And outperform this year, hopefully that's the start of a outperforming streak, but there is no guarantee in life. And but again, there is more value to be found among small cap stocks. But part of that is that microcap stocks have more volatility. So that's why you need to have diversification and consider all asset classes when your portfolio, not just small caps, unless you're perhaps very young and you are very aggressive or you have a lot of money and you don't mind sitting out a period of underperformance as far as that's concerned. Have expectations that are reasonable. Understand that these strategies take a while to play out. And again, if you want to capture this effect or any effect, you're much better off holding a large group of portfolios, and you could even do better if you start to winnow those down with some in-depth research of your own. So again, it's the markets are reasonably efficient, but we think there's probably more value to be found among these stocks that are trading in the shadows of Wall Street. So that's really, I think, an important consideration. This is still an individual stock portfolio. I think too often I hear from people who buy one or two and they're underwhelmed or out really excited. Well, that's like hitting the lottery. But if you want to really capture the effect, understand that you want to manage these stocks. You're going to hold on to these stocks. You can take a look at the periodic earnings reports, things like that. So managing a stock portfolio does take a little bit more work than simply buying a mutual fund or ETF. But again, it's if you a monthly review probably is all it takes, but it's still going to need some time and interest and some discipline to follow the approach in good times and bad. I know that Jenna has note of a special offer. I think there's a $50 off offer for all people who subscribe to our premium products this week. Jenna, you want to give us any additional color on that?
Yes, definitely. So you can visit AAII.com/webinar-week. You can see it on the screen. It will also be included in the resources that we send via email, and then it also available on AI.com/webinars. But if you visit that page, you can choose any new product. So let's say you have just basic AI membership, but you are interested in getting AI dividend investing or VMQ stocks. You can subscribe for a 1-year subscription and get $50 off when you use the promo code webinar week 50 at checkout. And this offer is valid through January 12th at midnight Central Time.
Thank you.
Yes.
Are there any questions, Jenna? Are we done for the day?
Yes, we have a ton of questions coming in.
Okay.
I do want to reiterate that if we don't get to your question during the broadcast, please email members@aai.com. We'd be happy to answer as many as we can. I have a few for you, John, and let's see what we got. Okay, so the first thing I do always like to ask during Model Portfolio Review Week is, did anything this year surprise you about either the portfolio holdings, the sector weighting, or just any small cap trends overall?
Any surprises? Well, I think this year was a very unusual year. There was a lot of, positive expectations. I mean, normally speaking, we came off a strong year last year, and then we had the election of a Republican president, and someone who's people I think viewed to be very friendly. The Trump put towards the stock market, towards the economy as a whole. So, I mean, I think when the initial tariff announcements came out, there was a big market negative reaction because no one really expected them to be as draconian as that was concerned. It was interesting because they very much held strong for a little while, but once kind of I guess the bond market kind of drove, I guess, the decision point there. But ever since then, kind of it, you know, small caps have done well, and towards the end of the year, people were more interested in rotating out of some of these, taking some profits in some of these high-tech companies and investing them in perhaps sectors and companies that have had better value, represent better value. So, if there's I guess a lesson to be learned is that it's been a year that had a lot of ups and downs, which they often do. But towards the end, we started to see more rational investing going on, and people were seeking out value.
Excellent. And I have actually quite a few people have asked, so we have kind of a mix. A lot of people shared that they are either former or current shadow stack holders, that they follow the portfolio pretty religiously. And then we also have quite a few that have mentioned that they haven't, but they are interested in getting kind of started. So a lot of questions kind of center around, would it be better to buy, the shadow stack portfolio? You suggest 10 at least. But are all at once, or should you try to time purchases? What would your suggestion be to those who are just getting started?
Sure. There's two ways to answer that question, and I guess there's no right way, no wrong way. If you want to gain comfort with it, you might want to paper trade for a while, or just buy them all and track them. We have our portfolio tracking tool on our website, and just kind of perhaps buy them all and just get a sense for what it feels like, what kind of volatility you might have in managing them. But I tend to jump all in. So if it were me, and this is not the right approach, necessarily for you, but for me, I would just simply go ahead and take any holding that it is in effect in the portfolio, doesn't have any kind of negative notes as far as earnings or reaching a value level, and just do equal dollar amounts, and that's going to give me the closest, greatest chance of capturing this small cap value effect. If I want to do a lot of homework, if I want to roll my sleeves up and I think I have some competitive advantages as far as hitting a company, then I would go ahead and cherry pick those holdings. But it depends upon how much effort you want to put into it. If you want to do as much as hands off as possible, just in effect get as many as you're comfortable owning, equal dollar amounts, and that'll in effect capture that effect over time. If you want to do your homework, do some cherry picking.
That makes sense. And I did see a couple investors talking about how, I guess wondering, is it better to kind of follow a full portfolio like the shadow stocks, or is it also, I guess, how do you decide between that and following like a small cap stock screen on AI.com?
Well, it's interesting. I guess with the most of it comes down to size as well. It's either approach can work well for you. I mean, Tiny Titans as an example is an approach that on our screening that has done very well. It's a micro cap approach. Its focus is price to sales as opposed to price to book, and it has momentum quality to it. So there's nothing wrong with following that. I guess the question is, there is no hand holding or regular reviews when it comes to following a stock screen, so you have to do it on your own. But if you don't mind doing that, they're both sound approaches, and I guess just look for some, again, understand that both approaches, the Tiny Titans, for example, is going to be relatively high volatile approach, small cap, same kind of characteristics that this will have. Its focus is price to sales as opposed to price to book. I think price to sales, one consideration is price to sales typically is more industry specific. It's not uncommon to have companies that have a lower price to sales ratio because their profit margins are smaller. But it all depends upon, do you want more hand holding and rule following? We have a very well defined set of rules, but whatever approach you do, whether it's following the shadow stock portfolio or one of our stock screens, is write down all the rules in advance and just give yourself track it religiously. Give yourself that discipline you need to follow it, because don't get distracted. If you are going to turn your head and not follow it for 6 months, whatever, then I'm not sure what's going to happen to your portfolio. So if either way, you have to make sure you track it. So they're both good. They have interesting ideas either way.
Makes sense. And speaking of, buy sell criteria and rules, has the shadow stock portfolios, rules or criteria changed over the years at all, or has it remained consistently about the same?
The rules have evolved over time as we've learned what makes sense to do when it comes to managing a microcap portfolio. When we first got started, there was no rule about positive earnings and selling stocks for negative earnings. We developed that as we found out that there were stocks that profitability didn't, they were unprofitable all of a sudden and they were still passing the screen, so it didn't necessarily make sense to include them. So we added things such as profitability. For a while we had price to sales as a criteria as well, but it didn't really change the resulting companies that much, so we ended up dropping it. The rules themselves are sort of dynamic in nature, in the sense that we're looking at a 10% band on either cheapness or size, so that what's acceptable as price to book market cap changes over time as well. So those have been kind of evolutionary type rules, but most of the rules have been looking at the difficulties of buying and selling microcap stocks. We've added rules avoiding foreign companies. We've had issues with occasionally foreign companies misrepresenting their financials. We had a company, I think it was based out of China, that was doing that. So these are we kind of adopt as we learn and change.
Makes sense. And I think you showed one of the charts you showed was the weighting of the different sectors of the portfolio. So if the shadow stocks portfolio is too heavily weighted in one sector, do you manually adjust, or how do you typically react? And then what is too heavily weighted to you?
Yeah, that's a fair question. It's interesting. With the model shadow stock portfolio, we don't actually do any kind of there is no rule to favor one sector over another when it comes to tiebreakers. And we have all the rules on our website, but there are no sector tiebreaker rules. So that is I follow the rules that are spelled out, and if we were to make a change, we would change the rules if we found it to be prudent. When it comes to determining, so there is for the shadow stock, there is no more, there is no ignore no more logistical companies, whatever. There's no more energy companies, whatever. So we don't necessarily favor one industry over another. When it comes to determining what would be a reasonable allocation of sectors, I would typically compare a portfolio against the overall, if you're going to be large caps, what is the normal sector range? So that's the best way to normally keep track to see if your portfolio is over diversified or under diversified across sectors. So if you're going to looking at a small cap, what's the sector breakdown for small caps or large caps? That'd be how I would do it normally if you wanted to have representation similar to what's in the marketplace.
Okay, that makes sense. And actually, another question kind of specifically about rules. If a stock is taken private and it was currently in the portfolio, how do you handle it? Like, what happens in those situations?
Well, you have no choice but to sell it because it'll stop trading. I mean, it's basically unfortunate that in effect has happened a couple times. In effect, it is the same as an acquisition or a buyout. We had a company that was actually, I think 2 years running now, we had companies that are bought out by private equity firms. When it comes to private equity, typically there are probably two types of private equity. People always think about these small cap companies that are emerging market companies but then a lot of companies are buyout private equity. They're taking underperforming companies that are publicly traded and buying them and in effect putting them into a pool. They can make them more profitable over time.
Makes sense. And I'll just do one more question. Again, we have so many questions. I really appreciate everyone submitting them. If we didn't get to your question and you'd like to, us to reach out, please email us at members@aai.com. We also have, I put in a ton of resources in the chat. We'll include those in the email, but those might answer some of your questions as well, as far as portfolio performance, how to use the stock ideas, et cetera.
And what I'll try to do as well is for an upcoming Model Shadow Stock Monthly, perhaps I'll do a Q&A session in there. I'll take your common questions and make that one of our monthly Model Shadow Stock Portfolio monthlies.
I like that. That's a great idea. And okay, let's see. One more question. Okay, so let's see. There's so many. I guess we'll kind of end on okay. So are there any specific red flags when it comes to small cap value stocks that you would tell investors to watch out for?
Red flags. That's a good question. And we're finding out ourselves is that make sure that they are up to date with their filings. Understand that there are differences between domestic companies and foreign companies as far as the frequency of their filings. So that is a big red flag. Quality counts. I know that we have a very simple quality screen. If you're investing in small caps, you're going to do much better if you exclude companies that are, poor financial quality. And I guess if you're looking for a little bit of a boost, I mean, it's momentum. There is some indication that momentum is another additional positive factor you can consider in terms of adding to your transactions. It will probably change your turnover rates and whatnot, but small caps, exclude the junk. There's a very positive affiliate. You would really boost your rate of return if you exclude the companies that are poor performing.
That's great. Those are good suggestions. Well, I want to say, first off, a big thank you to you, John, for guiding us through the Shadow Stocks portfolio. Your performance or presentation was fantastic. And I just wanted to offer, if you had any last minute things that you wanted to share with the audience before we kind of move into the outro and some promos and stuff.
No, well, I want to thank everybody for joining us today. I want to thank all the members who have really been an important part of our community here at the association. I'm an individual investor just like you are, and I really enjoy learning about these different techniques, and we'll be studying a wide array of techniques all week. And the Shadow Stock model portfolio is the first of many techniques and approaches we'll be tracking. So I want to thank you for your attendance, and thank you for your interest, and thank you for your support of the organization. I'm sure you're here because you want to educate yourself, and I think that personal education is the best way to really improve your rate of return over time, so that you make good decisions, that you're not scared about the market, you don't get overexcited, or you don't get overly scared. And hopefully you're doing this for yourself, and hopefully your family as well will benefit from your knowledge. So thank you for your support, and I look forward to this whole week. Thank you.
Yes, I am too. I hope everyone is able to and register and join us throughout the week. This is our first event of of our annual session. So I wanted to kind of go over the calendar. I'll go over some important information. But first off, if you have any questions about the Shadow Stocks portfolio, its performance, anything like that, please email us at members@aaii.com, or you can call us at 312-676-4307. That's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And then, like John mentioned earlier, the Model Shadow Stocks portfolio is a free included benefit for all AAII members. So no matter if you have any premium subscriptions or not, you have access to the Model Shadow Stock portfolio. And then I do want to reiterate, just because I know people are probably going to, we're a little bit over time. I appreciate everyone for, for staying with us. But all webinar attendees can get a $50 off 1-year premium product subscription when they use the promo code WebinarWeek50 at checkout. So you can visit ai.com/webinar-week to claim this exclusive offer. And it's valid through January 12th at midnight Central Time. And then if you'd like to attend any of the other webinar events this week, please visit aai.com/webinars to register. That's also where you can find all the recordings, the helpful information, resources, the PDF slides, everything there. So remember to visit aai.com/webinars to register. And the next event will be AAII Dividend Investing tomorrow, January 6th at 1 p.m. Central Time, and Charles Roblet will be presenting. Lastly, this presentation was recorded and a replay will be available at aai.com/webinars. We got that question a lot, so I always like to reiterate. And then webinar attendees will receive an email with a link to the recording, resources, anything that we think could be helpful in the next few days, early next week. So please keep an eye on your inbox. You'll receive a copy of John's presentation slides and anything that we discuss, all the things that I put in the chat. I know it goes really fast, so I want to always make sure that everybody realizes that. And then remember, we have events all week long, and those are all free to attend. So please join us at one or more scheduled this week. And with that, we wish all of you viewing a good health, good fortune, and a great rest of your day. Thank you so much for attending today, and take care.
Thank you. Take care.